Aviraj had first entered Nand's life through an introduction by Neelkant. Over time, he became more than an acquaintance, a trusted guide in important financial decisions. From helping Nand choose the right car to suggesting a thoughtful mutual fund investment strategy, Aviraj's advice had proved valuable. Now, their conversations were moving into yet another area of wealth creation. This time, Aviraj wanted Nand to understand the potential of dividend-yielding stocks. And so began a new discussion on earning not just through rising share prices, but through a steady stream of dividends. It was a quiet Sunday morning when Nand arrived at Aviraj's house with his laptop under one arm and an unusually confident smile on his face. Aviraj was sitting in the courtyard, reading the newspaper and drinking tea. The moment he saw Nand's expression, he folded the newspaper. "Aviraj, you look like someone who has discovered the secret of becoming rich." Nand laughed. "Nand, maybe I have." He opened his laptop. "Nand, I was researching stocks yesterday and I discovered something interesting. Dividend-paying stocks." Aviraj smiled. "Aviraj, and what did you discover?" "Nand, some companies regularly give money to their shareholders. So if I buy enough shares, I can keep receiving income without selling them." He paused dramatically. "Nand, isn't that almost like getting paid for doing nothing?" Aviraj laughed. "Aviraj, come with me." Nand looked confused. "Nand, where?" "Aviraj, to meet someone who has been earning dividends longer than you have been alive." A short distance from Aviraj's house was an old mango orchard owned by his friend, Keshav. The orchard was filled with large mango trees. Workers were collecting ripe mangoes into baskets. Aviraj stopped beside one particularly large tree. "Aviraj, suppose you own this tree. Every year, it produces mangoes. You can collect some of those mangoes without cutting down the tree." Nand nodded. "Aviraj, think of a profitable company in a similar way." Nand immediately understood where the conversation was going. "Aviraj, when you buy shares, you own a small part of a business. If that business earns profits, it can use those profits in several ways." Aviraj pointed toward the orchard. "It can reinvest money to expand the business, like planting more trees. It can repay debt. It can keep some cash for future needs. Or it can distribute part of the profits to its shareholders." Nand, "And that distribution is the dividend." Aviraj, "Exactly. So shareholders get some fruit without cutting down the tree? That's one way to think about it." They continued walking. Nand noticed another tree covered with mangoes. "Nand, look at that one. If I were buying a tree, I'd buy that." Aviraj didn't answer. Instead, he walked closer. Several branches were damaged. Some leaves had turned brown, and part of the trunk looked unhealthy. "Aviraj, you chose this tree because you saw lots of fruit. Would you still buy it without checking its health?" Nand examined the tree. "Nand, probably not." Aviraj smiled. "Aviraj, then don't select a dividend stock only because its dividend yield looks high." Nand looked intrigued. Aviraj explained that dividend yield broadly compares the dividend received per share with the share's market price. "Nand, so higher yield means more dividend income relative to the price I pay?" Aviraj, "Yes, but that's only the beginning of the analysis." Nand looked surprised. "Nand, I thought higher was automatically better." Aviraj, "And that's where many beginners can make a mistake." They sat under the shade of another tree. Aviraj picked up a mango. "Imagine a company pays a dividend of 10 rupees per share. Suppose its share price is 200 rupees. Nand calculated quickly. That's a 5% dividend yield. Aviraj nodded. Now imagine something goes badly wrong with the business. Investors become worried and the share price falls to 100 rupees. Nand thought for a moment. If I calculate using the previous 10 rupees dividend, the yield appears to become 10%. Exactly. Nand smiled. So now it's twice as attractive. Aviraj raised an eyebrow. Nand stopped smiling. I'm guessing that's the wrong answer. Aviraj laughed. The question is, why did the share price fall? Perhaps the company's profits are declining. Perhaps debt has increased. Perhaps cash flows are under pressure. Perhaps the business itself is facing serious problems. And if profits deteriorate, the company may eventually reduce or even stop its dividend. Nand looked back at the unhealthy mango tree. So sometimes an unusually high dividend yield could be high because the market price has collapsed. Exactly. A high yield can sometimes be an opportunity, but sometimes it can be a warning. Aviraj pointed toward the soil beneath the tree. Aviraj, if you want mangoes for many years, where should your attention be? Nand, the roots. Exactly. The dividend is the fruit, the business is the tree, and its fundamentals are the roots. Nand opened the Notes app on his phone. Aviraj continued. Before getting excited about dividends, an investor should try to understand the underlying business. Is the company profitable? Are its profits reasonably sustainable? Does the business generate healthy cash flows? How much debt does it have? How much of its earnings is being distributed? How much is being retained to maintain and grow the business? Has the company demonstrated a sensible approach to distributing profits over time? And does the business still have opportunities to grow? Nand, so dividend investing is actually business analysis? Aviraj, all investing should begin with understanding what you are buying. Nand suddenly had another idea. If dividends are good, why shouldn't a company distribute all its profits? Aviraj pointed towards several young mango saplings nearby. Suppose Keshav sells all his mangoes and distributes every rupee he earns to his family. What happens if he never spends money planting new trees, maintaining the orchard, or improving irrigation? Nand looked around. The orchard could eventually suffer. Exactly. A good business sometimes has attractive opportunities to reinvest its profits. A growing company might need money to open factories, develop products, expand distribution, improve technology, or enter new markets. So, a company paying a smaller dividend isn't automatically worse than one paying a larger dividend, because the money it keeps could potentially help the company grow. Correct, provided management uses that money wisely. Nand nodded. He was beginning to see that dividends weren't as simple as they first appeared. As they were leaving the orchard, Keshav handed them a basket of mangoes. Aviraj took out one mango and removed its seed. Aviraj, what can you do with this? Nand, plant it. And potentially, grow another tree. Aviraj smiled. Aviraj, now you're ready for the next idea. Suppose an investor receives dividends but doesn't need that money for current expenses. Instead of spending it, the investor may choose to reinvest it by purchasing additional shares, subject of course to price, valuation, taxes, costs, and whether the investment still makes sense. Those additional shares may potentially generate future dividends too. Those dividends could then be reinvested again. Nand, so the fruit helps me plant more trees. Aviraj, that's the idea. Over long periods, reinvesting dividends can contribute to compounding. Nand stared at the mango seed in Aviraj's hand. One tree, fruit, seeds, more trees, more fruit. Aviraj laughed. Aviraj, just don't expect the stock market to grow as neatly as an orchard. On the way home, Nand asked another question. Nand, but receiving a dividend still feels like free money. Aviraj stopped walking. Aviraj, remember something important. A dividend isn't a magical bonus appearing from nowhere. The money comes from the company's resources. When a company distributes cash to shareholders,
That cash leaves the business. The market also takes dividends into account when valuing shares. Aviraj. So don't think of dividend investing as a machine where you put 100 rupees inside and it keeps throwing free 10 rupee notes at you forever. Nand laughed. There goes my retirement plan.
Back at the house, Aviraj placed 2 mangoes on the table. Another mistake is looking only at dividends. An investor's outcome can include both the cash received from dividends and changes in the value of the investment. A company paying a generous dividend while its business steadily deteriorates may not create a good overall outcome. Meanwhile, another company may distribute less because it can productively reinvest more of its earnings. Nand said, "So I shouldn't ask only, how much dividend will I receive?" "Correct." Nand thought for a moment. "I should ask, what kind of business am I becoming an owner of?" Aviraj smiled. Nand opened his notebook and began writing. Before considering a dividend-paying stock, he would examine the quality of the business, profitability, cash flows, debt, dividend sustainability, payout policy, growth prospects, and valuation. Then he added one more question. Why am I buying it? Was he looking for current income? Long-term wealth creation? A combination of income and growth? Or was he simply attracted by a large percentage displayed on a stock screening website? Nand closed the notebook. Nand. I came here thinking dividend investing meant finding stocks with the highest dividend yield. And now? Nand looked toward the orchard. Now, I think it's about finding healthy trees. Aviraj smiled. There's one strategy worth keeping in mind, Aviraj told Nand. Identify strong dividend-paying companies beforehand and wait for the market to make them dirt cheap. Businesses with real substance, hard assets, strong balance sheets, healthy cash reserves, sustainable cash flows, and the ability to survive difficult economic cycles. When a serious slowdown comes, fear takes over, and the market starts pricing businesses as though the economy is going to collapse, Aviraj explained. Even good companies get beaten down, and if their dividends remain sustainable, the sharp fall in share prices can make their dividend yields extremely attractive. Nand nodded. So you earn a healthy dividend while waiting for the business and its share price to recover. Exactly, Aviraj replied. But a high dividend yield alone isn't enough. The company can cut its dividend, and the share price can always fall further. That's why the real work happens beforehand. Build a list of cash-rich, asset-backed businesses with manageable debt, strong cash flows, and a dependable dividend history. When the downturn finally arrives, you shouldn't be starting your research. You should already know which businesses you want and the valuations at which you are willing to buy them. Then you simply ask, has something fundamentally changed in the business, or has fear merely changed its price? If the business remains strong and the valuation becomes compelling, you accumulate. Aviraj leaned back. That's the whole idea, Nand. Find the businesses when nobody is afraid, buy them when everybody is. The dividend is only the fruit. I need to understand the roots, the strength of the tree, whether it can continue producing fruit, and whether the price I'm paying for the tree makes sense. Aviraj picked up his tea. Now you're thinking like an investor. Nand grinned. So, should we search for some good dividend stocks? Aviraj shook his head and laughed. First, learn how to analyze the business. Nand sighed. You never let me take shortcuts. Aviraj looked toward the mango orchard. Because in investing, Nand, the person chasing the biggest fruit often forgets to check whether the tree is healthy. Nand looked at the mango in his hand and smiled. This time he understood. A dividend can reward an investor today. A strong business can potentially reward an investor for years. The real skill is learning to distinguish between the two. Thank you for watching our video on dividend-yielding stocks. We hope it helped you understand how dividends can create a steady stream of income. Remember, a good dividend stock is about sustainability, quality, and long-term growth, not just a high yield. Keep learning, invest wisely,
and let your money work for you over time.